So it was, I hate being wrong, sitting here, 87% chance last night, now down to 73%. Does the stock, not bond, does the stock market care about a rate cut?
I think so. There was this time last year when the S&P was about 1,000 points lower than we are now. The market was pricing in 6 rate cuts in 2025. Here we are now 1,000 points higher. We're talking about 2, maybe 3. So I would say all of that good news in terms of just rate cuts are priced in. So the short answer is absolutely. The market will be disappointed if they get anything less than.
I think the market really cares about a dovish Jerome Powell more than anything. I think even if they cut, don't cut, whatever, I think dovish Powell is very good for the market. I don't think that's what we'll get.
What's the Powell you think we have?
I think not dovish, closer to hawkish. I'm just saying, what would the market like? Dovish Powell, I think he'll be neutral.
Tim, what's the Powell we deserve?
Well,
deserve ain't got nothing to do with it.
The Powell we deserve, but no, Dan may have been somewhat tongue-in-cheek, but the Powell we deserve is consistent with the Powell we've had. The Fed we've had so far should not be cutting in September based upon the heat of that PPI number. The 4-week job average on the jobless claims we just got this morning show that even during that payroll, even with some of the tick up during the August payrolls, that there's no material weakening in the labor market, okay? Inflation is better than where they have been, and this is a Fed that's been data dependent. So back to the Powell I want the Powell that's following the script that Powell has had. And I think what we have going into this is I think probabilities are higher based for the market on the cut based upon the politics. But that's okay. I mean, ultimately.
What politics?
Well, there's no disputing I won't get into the politics.
Let's get into the politics.
No, I don't want to use the P word. I'll talk about the fact that in the last month, since at least some of the heat has been more on the Fed, you've seen home builders rally 16%. You've seen retail rally almost 5%. You've seen interest rate sensitive parts of the market have an outsized move. There's no question the market has been moving on some sense that we are getting into a dovish environment.
Okay. So what I heard, the Fed minutes, Dan, we normally, we do them. I don't pay that much attention to them. Yesterday I did because the Fed minutes revealed they are worried about inflation. They're worried about tariffs. That would signal no rate cut. I mean, it could even signal a rate hike. But at the same time, they said they're worried about the job market and how AI is going to impact jobs. So if you're worried about jobs, that's a rate cut. If you're worried about inflation, that's not. How do they balance out?
Well, all this worry here. I mean, come on. I mean, they also said they're worried a little bit about asset prices. I don't know if you caught that one. I thought that was kind of interesting also. But, you know,
what does that tell you?
We talk about all that worry, and I think what Tim's saying is the market's been climbing a little bit of wall worry. I know that's a line that Guy likes to use pretty often. If you look at the options market, it's pricing about a 3% move between now and the Fed meeting. So what do we have between now and the Fed meeting? We have tomorrow. We have the jobs report on September 5th. We have CPI. We have PPI, maybe the Fed's most favored inflation.
PCE.
Yeah, that's it. And that seems very complacent to me, you know? So if you're looking at the markets right here and you want to get long, you want long exposure, it's 1.5% between now and September.
So what if we get a hawkish Jerome Powell, a defiant, maybe not political, but a defiant and hawkish Jerome Powell tomorrow?
I don't think he's going to be defiant. I mean, I think he's learned how to talk to the market. I think he's learned how to talk to the media. So defiant is not a word I would use, but I do think hawkish is an absolute possibility with everything that's going on. And, you know, I'll say it again for the umpteenth time. They can do whatever they want tomorrow. I mean, take a look at what's going on in Europe, and we're going to talk about this a little bit more. Rates are going up across the world right now, except where in Switzerland, where they're collapsing. Why is that? Because their debt is about 37% of their GDP. So countries that are laden with debt are being punished in the form of their yields going higher. We are one of those countries.